Something strange is happening in the bond market, and it might be a red flag for the economy. Last week, Treasury yields spiked dramatically, even on days as the stock market was falling. Typically, that's not supposed to happen. So what's going on here? Normally, when stock markets fall, particularly in a financial environment under stress, investors rush into bonds, especially U.S. Treasuries. This is what's meant by flight to quality. U.S. Treasury bonds are considered the safest assets in the world. This demand pushes Treasury prices up and yields down because there's an inverse relationship between the price and the yield of a bond. That's exactly what we saw in the first couple of days after President Trump announced new tariffs when the market closed on April 2nd. The next day, the S&P 500 dropped 5%. Then on the following day, it declined another 6%. Treasury yields fell during that period as expected. The 10-year yield declined 20 basis points and bond prices rose. But then came last week. Stocks kept bleeding the earlier part of the week, though not as sharply, but at the same time, the yields of Treasury bonds surged. The 10-year jumped from 3.9% to 4.3% in just 2 days based on intraday prices. And even though the S&P 500 gained 10% on the day that President Trump announced a 90-day pause on the tariffs, Treasury yields continued to rise every day last week as the stock market subsequently moved sideways. From the bottom to the top of the chart here, the 10-year yield rose 73 basis points in 1 week based on intraday prices, an unusually large move in a short period of time. So why would bond prices fall at the same time the market is under stress? Let's walk through 4 possible reasons. First, this kind of decoupling has happened before, like during the financial crisis of 2018. Let's go back in time and take a look at the chart of the S&P 500 from that period. You may recall that Lehman Brothers collapsed on September 15, 2008. The broad equity index fell 16% over the following 1-month period. However, the Treasury market, instead of acting as a safe haven as they usually do, also fell during this time of stress, and in fact, the 10-year yield went up by 61 basis points. Markets may have been flashing a deeper warning this week, similar to the 2008 financial crisis, and that might explain why Trump quickly walked back his tariff policy. The S&P 500 index actually bottomed on Monday morning of last week, then moved sideways in choppy trading the rest of that day. That suggests a battle between buyers and sellers, and for leveraged investors facing losses, margin calls would have forced them to sell their most liquid assets, their Treasury bonds. Here's a more unsettling idea. Maybe some investors started to doubt Treasuries altogether. With tariff uncertainty and geopolitical tension, it's possible that some global investors questioned the full faith and credit of the US government. It takes a lot to get there, and we don't have hard data to prove it. In fact, the Treasury bond auction last week wasn't so bad, but a loss of confidence, even if temporary, could trigger exactly this kind of bond sell-off. Finally, China. They hold around $759 billion in U.S. Treasury bonds, and as trade tensions heat up, dumping Treasuries could be one of their weapons. It would be drastic, and risky for China too, but that possibility is not off the table. In normal markets, Treasuries are a safe haven, but when fear reaches a tipping point, even the safest assets get shaken. This week's bond market volatility wasn't just noise. It may have been a signal of deeper market stress. Thanks for watching this first episode of Money Markets and More. I'm just getting started with this channel, so if you found this useful, or even if you didn't, drop a comment below. I'd love to hear your thoughts, feedback, or what topics you'd like covered next. Hit that subscribe button. I've got more coming soon.